Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present another episode of our Macro Bundle Live. I'm super excited today to be joined by our friend Nick Halaris, founder of Metros Capital. Nick, how you doing today, man?
I'm doing great, man. Thanks for having me here. How are
Uh,
you?
it's a real pleasure, man. You're a really sharp guy. You do a lot of great work, both obviously in terms of the business you founded, but also in terms of your podcast, which I was recently featured on. That was an outstanding episode for those of you who've not yet to have a chance to check that out and or to subscribe to this podcast. I highly recommend you do so. Nick, give us a little bit of background with yourself in terms of what you do in Metros Capital and how you kind of got into this investing business.
Yeah, sure. So Metros Capital is a company I started back in 2016, and it's essentially the second iteration of my real estate career. I had founded another company in the depths of the Great Recession, or the Great Financial Crisis in 2009, called Capital. And Metros is sort of the second iteration of this. And we've been focused on different types of strategies over the course of that career, depending on what's happening in the macro landscape. So we've done everything from buy and sell foreclosed single family houses in LA. So buy and fix them up and sell them, to building a huge portfolio of distressed multifamily assets in the sort of immediate aftermath of the GFC, to, in recent years, kind of going into COVID, it was so competitive and so tough out there for buying real estate assets that we were pursuing an ultra luxury development strategy here in my hometown in West Hollywood. So building like outrageous location apartments and trying to earn some return that way. And now we're kind of in wait and see mode, and we can talk about that. But in the meantime, I've also been writing a newsletter, which I started, called Profit Plus. And then I have a podcast called the Nick Halaris Show. And your episode was one of our most popular. And so I
Thank
appreciate
you.
you coming on the show, and would love to have your followers, check us out.
I appreciate that, Nick. Thank you, man. So even before we get going into the actual discussion, what like you mentioned, you sort of done like three very different things already in your real estate career. Like, what kind of creates that opportunity? Is it just sort of like scan the nation, where's the best opportunity set, or is there something else from a macro standpoint that says, okay, this is where I should be focusing my time, effort, and capital?
Yeah, it's a great question. It's something I've thought about a lot because, I ended up coming to a broader interest in investing and in macro, actually, sort of in what you do, because of what was happening to me in my real estate career. So as I was going along, I was always sort of interested in investing to begin with, reading financial press and stuff like that, and reading interesting books about it, but never trained, formally. I didn't work at a Wall Street firm. But as I got into real estate and I started to pursue these strategies that I actually built businesses around. So like my house flipping business, for example, I had like 100 employees at one point trying to do that.
Wow.
And these macro forces started to come in and mess it all up. So like in that instance, Blackstone and several other large institutional players figured out that they could also pursue this strategy involving single family rental or single family foreclosures. And they brought like a tsunami of capital into the industry and drove the margins to zero, essentially, in a very short amount of time. Like, we were making 40% margins on our deals, and it went to zero in like less than 12 months.
Wow, that's nuts.
Yeah, exactly. It's like, holy crap. So I have built this whole team, and then there's no opportunity. It's like, oh, okay, now what do we do? And something similar happened with the apartments. We started buying apartment buildings that were distressed kind of in 2011, 12. And within 18 months, we bought 3,000 units. So we were like really aggressive. 18 months later, like that tsunami of capital had like turned its attention to that strategy. And then all of a sudden, now I'm competing against incredibly well capitalized institutions with full teams and the ability to just move quicker and more aggressively than I could. So then I was like, okay, I need to get out in front of this stuff. And then I went on sort of a learning journey. So maybe for like 2 or 3 years, I did a huge deep dive in investing, read hundreds of books, and subscribed to a bunch of newsletters back at the time, and read all kinds of things. And now I've sort of become a writer myself as a result. So
it's a great bug to catch, man, for sure.
yep.
So one of the reasons I've been super excited to talk to you on this, and listeners, Nick and I have been going back and forth really since the early part of the summer, like kind of at the height, or really since the tail end of the regional banking crisis, because the clear spillover from that was clearly, okay, we're going to have some problems in commercial real estate. maybe not today, maybe not tomorrow, but we very much can clearly see the storm clouds on the horizon when we look out the window. And so I'm excited to kind of pick your brain. You've got boots on the ground, not just in West Hollywood, but also across the country with your business. So without further delay, you put together some slides to us for us. I kind of want to just kind of help you walk through those and pick your brain as we go through those. Is that okay?
Yeah, let's do it.
All right, let's do that. So, Colin, if you can throw the next slides on the screen here. We'll start with this first chart here. So it's U.S. commercial property prices. This is obviously an index level to August 2007. So clearly, we are obviously moving in the wrong direction off of a very high level. What's the key takeaway from here?
Yeah, I think the key point with this picture is that you sort of alluded to it in your remarks just a second ago. In many ways, what we're in right now is like the absolute perfect storm for a disaster to emerge in commercial real estate,
Mm-hmm.
because we're talking about like a confluence of factors that are bad for real estate, and most importantly, it's the rise of interest rates. So interest rates were at the floor during COVID, and they're up like on the short term, they're up like 500%, right?
Mm-hmm.
And for real estate investors, they're probably 2x. So if
Yeah.
you were borrowing in the fours, now you're borrowing at 8, maybe higher than 2x, maybe 2 to 3x. So that's a real problem for a real estate investor, depending on their situation. So you have that. Then you have some sort of weakness at the leading edge of the economy emerge. So you get the crypto blow up, you get the tech companies laying people off,
Mm.
and all this is sort of happening in the background of the disaster that's happening in the office space, where people aren't going back to work and they're abandoning their leases, and offices, even in a good situation, are like 50% occupied.
Mm.
And then you get a banking crisis. And the last time you had a banking crisis, like you can see the chart, like in the middle of that chart, like commercial real estate got crushed. It was down like 40% or something like that
Wow.
when you had the last GFC. Now that was a particularly nasty banking crisis, but it shows you what's possible. And if you go to where we are today, like there's been some damage to the real estate valuations, but not that bad,
Yeah.
especially in context of what happened last time. And
Yeah.
that
I
to
mean,
me is kind of strange.
it is strange. I mean, we're basically only back to where we were prior to COVID. So you can
Yeah.
make the case that all the kind of the funny money that juiced the economy in the form of fiscal monetary stimulus. My favorite stat from that whole period, that era, is that we grew the budget. We grew public debt by $6 trillion, and the Fed monetized half of that in the 2 years ending in December 2021. So that clearly is represented in this big spike in the chart. And now we've sort of just retraced kind of that big spike. And you're suggesting that A, this could be a blow off top, and B, we could potentially be headed much lower. Do you have kind of an insight on how much lower and how much longer this is going to play out, or is it too early to tell?
I think it's a little too early to tell. However, my gut tells me that we haven't seen the end of this.
Yeah.
There's a lot more damage coming. Um, it's not true. The story isn't true in every sector, for example, but in general, like I think that chart resolves lower before it goes back up. Like there's more pain coming.
Makes a lot of sense. All right, let's keep moving here to the next chart here. You got distress levels in U.S. commercial real estate. Talk to me about this chart here.
Yeah, I wanted to share this chart just to show your audience just how bad it can get. So we've seen an uptick in distress in real estate. There's no question about it, but it's actually not as bad as it was in the GFC, despite the fact that if you looked from a qualitative standpoint, like we just discussed, qualitatively it looks like a perfect storm brewing, but the data so far is not showing as serious of a problem as we've seen in past cycles.
Why do you say that? Well, or sorry, not why do you say that? But obviously the data is telling us that. But why do you think that that outcome is the case?
Yeah, I think there's sort of three reasons actually that I've been thinking about. Number one is I think actually, and this one is probably the most important, or maybe it's the second most important, but it's one that people should understand, is that the banks actually learned a really important lesson from the GFC.
Mm.
And that lesson was that the rapid withdrawal of liquidity from the real estate market is going to hurt them.
Mm.
And so they should do their best to be patient and calm with their borrowers.
Mm.
And it's manifested in the market in the form of just banks that are more flexible. They're willing to extend loans. They're willing to overlook a covenant. Like, let's say you have a debt service coverage ratio that you're supposed to hit. Well, back in the GFC, they just foreclosed on everybody. They just sent notice of default, start foreclosing on everyone. And that is one of the reasons why property prices got crushed so bad. But then the banks, they had egg on their face by like 2012, when a lot of these properties that they foreclosed and sold to sort of vulture type investors at crazy prices traded at 100% higher or 50% higher or whatever. And so they learned that lesson the last time, like, hey, maybe if we're a little bit calmer and a little bit more flexible, like maybe we're not going to have as big of a problem.
Mm-hmm. Gotcha. So basically, they learned their lesson. They panic sold the lows last cycle, in part because of that real big serious capital concerns. And you can effectively say, hey, they have better risk management in place, primarily through the lens of just being more better capitalized in this particular business cycle. And so their need to panic sell the lows, at least this early in the process, is much reduced. Do you see this changing at all? Like, let's say we roll the clock forward and it's, I don't know, this time 2024. Is the chart still going to look the same in terms of like their willingness to extend and pretend, or are we going to start to see an acceleration? And if so, what will cause that acceleration?
Yeah, I think that's like the $1 trillion question, I think, is to how long they're willing to do that. And before I answer that, let me give you the other two reasons why I think this dynamic is emerging in the data. So the other one is that, and this is something you've been talking about, we've got this like Goldilocks situation.
We do.
Where you've got an economy that on paper qualitatively looks like it should be in real trouble, but it's not. And there's growth happening, and you're more in tune to why that is there, but it's impacting real estate in a positive way. So you have like retail is doing really well, hospitality is doing really well, and even multifamily, which may have its own sort of problems we can get into later. Even multifamily is doing fine because there are no job losses. People are paying their rents.
Mm-hmm.
Only place where there's like real damage, like for sure, is office, where you've seen some really crazy trades, properties trading at 10, 20% of replacement cost, that kind of stuff. But everywhere else is fine because of this Goldilocks economy is a big factor.
Yeah, 100%, man. This is something we've been banging the table on or pounding the table on since over a year now, going back to last summer when we introduced this resilient U.S. economy theme. We've been very much against the view that the U.S. economy would experience a recession to date, since going back to that theme. And, we've been accumulating positive factors for why that is the case. Most of these factors, or at least half of these factors, were there last summer, but since last summer, we've actually accumulated incremental information. So I'll just quickly run down the list. We don't have to unpack each one just for the sake of time. But number one, we have household balance sheets that are flush with cash. We have corporate balance sheets that are flush with cash. Number two. Number three, we have ample liquidity, and it's made the private sector impervious to rate hikes. Number four, we have long and variable lags. The cycle, I always trip up when I say that. Number five, we have limited credit cycle vulnerabilities. Number six, we have limited exposure to the volatile manufacturing sector. Number seven, we have a perfect storm for new housing development. Number eight, we got Bidenomics dumping trillions of dollars of cash into the U.S. economy. And then number nine, immigration, and number 10, labor hoarding. So when you put together all these factors, some cyclical, some structural, some will dissipate, some will be persistent, you kind of explains a lot why this U.S. economy itself, and more importantly, the U.S. labor market has really been able to hang in there. And so you kind of roll the bouncing ball forward. This is partially one of those reasons why we've seen banks, happy to extend and pretend, and ultimately have not seen that level of distress in the commercial real estate sector, at least not yet.
Yeah, I'm glad you showed that list too, because I just looking at it, there are several of your themes that are part of this little deck that I sent over. Mm-hmm. So, like for example, the ample liquidity. There's another chart in here that we should look at real quick.
Yeah, which one?
Where is it? Go down a little bit farther. I think this one right here, the dry powder one.
Oh, dry powder. Yep.
Yeah. So, look, this is something the Wall Street Journal reported on like 10 days ago. There's like $200 billion of dry powder sitting on the books of the private equity companies for real estate.
Wow.
And so you don't have a liquidity issue. So real estate gets crushed when there's a liquidity issue. And the two things that could cause a liquidity issue are banks being aggressive about foreclosures and there being no private capital to come and do deals. And look, that's not a problem. There's a lot of private capital out there. And these people are financially incentivized to spend it, right? If you're sitting on a management team of one of these private equity companies, the last thing on earth you want to do is not do a deal, because then you don't get paid your fees. It's like,
It's how
so
Wall Street works.
yeah.
Yeah.
um,
So in terms of this ample dry powder, and I don't mean to go out of order of your
yeah,
slide. We can go
no,
back
it's
to
okay.
the original order here, but just one question on this dry powder. Maybe it's for the next round of slides. What sort of like gets the dry powder from being dry to wet? I guess like what's keeping the dry powder dry? Is it just that we haven't seen enough of a correction in price yet? We've not seen enough distress yet, so these folks are just like the valuations don't work for me at this particular price level. What's really causing this not to be put to work?
Yeah, I think it's sort of like a balance of two forces. So I never mentioned my third reason why we haven't seen much distress, but this is a
Oh, yeah.
good point to mention it in the conversation. So there's another dynamic of real estate which I think a lot of sort of stock market focused investors don't understand, and that's the structural and bias of inflation within the industry. Like if there is like a strong inflation expectation in our system, it's that people who play in this game that I'm in, real estate, they think real estate prices always go up.
Mm,
It is by far the strongest inflation expectation in our system. It was what was one of the main drivers behind the housing bubble, right? Housing never goes down.
yeah.
And what's interesting is that that expectation sort of plays out in the data. So I have another chart in here that shows like multifamily rents. This one right here.
Oh, right here.
So yeah, this is multifamily rents in the GFC. So this is an environment where property values are down like 40% and rents are like barely down, right? We're talking like nothing. And
4%.
yeah, and so we just went through a period where during COVID, like multifamily rents were up 15-20% per year for 2 years in a row.
Mm,
And so there's this inflation expectation. We had a whole decade of inflation in real estate. Then we had the COVID blow off top. And investors have been trained for like 4 decades to just assume that even if you get a financial crisis, if you can hold on to your properties, you're going to maybe experience a little rent decline, but you're going to get on the other side of that and your properties are going to start performing even better than you expected because there's going to be sort of this rebound in inflation.
hmm
And so if you go back to the final chart on this deck, it kind of shows, it's a good illustration of what, not this final chart, maybe one or two up actually.
This
Sorry.
one.
No, next one. Sorry, one more. No, maybe not. Oh, this is right here. Okay.
Yeah.
Gap between buyers. So this is what's happening basically. The potential sellers of real estate have just different expectations about the value of their property than the buyers do. And so the
Mm,
buyers are kind of on the sidelines, and there's the way this is manifesting is there's less transactions happening.
yeah.
But the reason this exists though is because of that inflation expectation. If you're a holder of real estate, the last thing on earth you want to do is sell your property right now, because even the chart at the beginning, even though it's not down huge, it's still down. And if you just sort of hold on, you're probably going to experience inflation and increase in the value of your property.
Gotcha.
So that's the dynamic.
So and quick so thank you for explaining. That was really detailed and thoughtful. I just have one follow-up question with
Yeah.
respect to number 3 on this chart here. Is a positive value means the buyers expect prices to go up more than sellers, and negative value means buyers expect prices to go down up less than sellers. I assume it's always up.
Yeah.
Yeah.
Yeah. Yeah.
Gotcha. And so, yeah, in order to sort of get the market to clear, I mean, obviously the GFC is like a once in a generation event, but we're probably, as we've just indicated in terms of the bankruptcies and foreclosures, we are still not yet at sort of clearing price levels for this particular asset class, at least with respect to family apartments. So that would seem to suggest that the extend and pretend game should go on a little bit longer, right? As long as this gap has emerged and we can just sort of have a transactionless market, if you will,
Yep.
then the game can continue, and it should continue, right? As long as there's no giant maturity walls and all that kind of stuff. So, talk to me about kind of the leverage and lending in the real estate space. You put together this slide here,
Yeah.
relates to cap rates and debt service and cash flow, kind of metrics.
Yeah. I wanted to share this data because it illustrates the problem that exists in the market when rates go crazy. So this chart is essentially like imagining a $10 million property that traded at a 5 cap.
And before for our listeners, because you had to explain this to me a while back, I didn't really
Yeah.
understand it. what is a cap rate? How do you get to it? I know there's some shenanigans that can influence that, but like give us the kind of the basics to understand, cap rates, because they're obviously a very important driver of real estate.
Yeah, like at its core, it's essentially looking at the unlevered return of the asset.
Mhm.
So it's like what kind of net income before accounting for things like interest payments can the asset produce? And the way you play shenanigans with it, by the way, is things that are operating expenses, you move them to the balance sheet. And so
Mhm.
your numbers look a lot better, but that's another conversation. But
Yeah.
at its core, it's essentially saying like, okay, this apartment building, if I bought it for cash, what am I going to get every year?
Gotcha. Gotcha.
And
Gotcha.
what was crazy about the world going into COVID was that basically the entire commercial real estate world was trading at a five cap or less. And so if you think about that, like, okay, the hunt for yield had gotten so crazy that you essentially, as a real estate investor, couldn't really earn a significant cash flow return on it on your investment
Mhm.
because right, like whatever you believe about the CPI, like if you're buying an asset earning five and CPI is at two, your real return's three, like is 3% return a large enough return to justify holding a single purpose asset in a city that has the potential to burn down or
Mhm.
have a large capex bill? Like the world had gotten so crazy that there was no real cash flow return for these things. But what investors were doing with them is just treating them like financial assets and financial engineering them with low cost debt, raising the rents a little bit and then flipping them to the next player. So real estate going into COVID had become a fully financialized game. Nobody was buying these things for cash flow. Even the pension funds, like on paper, they were buying them for cash flow, but all of the sort of sponsors who were managing those projects were all playing the same game, which is to try to flip the
Mhm.
property to the next buyer, right?
Gotcha.
COVID comes in and it gets even crazier. So this dynamic. So like there were places around the country where properties were trading in the 3 and 2 cap. So imagine that. Imagine buying a piece of real estate and you're going in potential to earn cash flow of 2%. It's kind of crazy. That's how the world we started with.
And what would I mean? Obviously, we lived in this like QE, Fed balance sheet expansion, central bank balance sheet expansion era for better part of a dozen years or 13, 14 years. Has that been the primary driver, or has that been just sort of like other factors that kind of drove cap rates down? So you can obviously think about cap rates, as the inverse of valuation that drove valuation up or cap rates down in terms of like underbuilding, undersupply, things of that nature.
Yeah, I think it's probably a trend that started in the early 80s
Mm,
and then it got crazy in the post GFC era for sure. When interest rates no longer existed, the hunt for yield drove out all of the cash flow returns from real estate assets
gotcha.
because there was nowhere to go, right? Like if you were a cash flow seeking investor in those years, what do? You
Yeah.
can't buy any bonds. Half the world had like not half the world, but a big chunk of the world had like negative interest rate debt. Corporate junk bond was not giving you any yield, so it just you let that go for a decade and you get like a lot of excess, and
Yeah,
that
makes
that's what we
sense.
were that's what we were seeing. Yep.
Gotcha, gotcha. So walk us through this table. This
Yeah.
table, it's
Okay. So when you read about people in the news, like there's a lot of news stories about developers in trouble, office property owners, multifamily syndicators in trouble. This is why they're in trouble. In the COVID era, there was the speculative fever that we saw manifesting in places like crypto and venture. It made its way into real estate. And the way this manifested was that people, new players essentially, relatively inexperienced people, bought a bunch of properties using floating rate debt. So if you
mm,
take a $10 million property at a five cap and you finance it with 4% debt, you can earn money. That's what that cash flow line at 4%. You can earn a good return, a good net cash on your investment at almost any leverage level.
mm,
But if you jack rates up to nine, you start losing money very fast. And that's assuming a five cap. And I think the point to people should remember is like a lot of deals traded for less than five caps. So they're underwater even more than what this chart is showing. And so,
Gotcha.
yeah, I would just want to show it's like arithmetic. Like this is what people are facing. And now what's happening in office is that not only are many office properties facing like math that looks like this on the debt side, but their
Mhm.
top line has gone to zero.
Oh yeah.
If they were a 5 cap going into COVID, they're nothing now. They're a 0 cap.
There's zero cap.
They have no income.
It's an error in Microsoft Excel.
Exactly. You literally it does not compute. That's what's
Yeah.
happening. Yeah.
No, so this is, I mean, I'm so glad you put these numbers on the page because you hear distress in real estate and for the most of us and just TradFi markets or liquid asset classes, if you will. We don't really think about things in this nature. The bond guys do occasionally, when they have to compute DV01 and all this stuff. But this is shocking. I mean, if you think about what's actually going on for a lot of borrowers out there, and so in terms of the general borrower, if you will, who's investing in property, where are they on this loan to value loan to value spectrum? Like, is 50% LTV pretty normal, 80% normal? Where are they on the spectrum, generally speaking, across the board?
Yeah, no, I think this is another difference from the GFC. So in the GFC days, they were so financially irresponsible, they meaning the banks, that the LTVs were in some cases over 100 going into the GFC.
Take as much money as you need.
Yeah.
We'll call you.
Yeah. So this time around, the banks had learned their lesson, and it was pretty difficult to get even to 80.
Mm,
So I think the vast majority of players are probably closer to 65, 70.
mm,
And the difference between sort of the things the people you're reading about in the news who are struggling are the ones who put floating rate debt. Anyone who put fixed rate debt is in a phenomenal position.
yeah.
And this is what the experienced investors have done. You get fixed rate debt, so you lock it in. Like not to talk our own book, but we have a bunch of assets financed with stuff in the threes.
Mm,
And look, if you can borrow money at 3, it's hard to find yourself in a distressed situation. But we do have a few transactions where we have floating rate, and those are painful for us because borrowing costs went up. And I think what's happening out there in the world is that the high profile cases are usually syndicators like doing these transactions with floating rate debt. And the problem with being a syndicator is that if you need fresh equity, you have to go back to the crowd and try to raise it. And that's a challenging prospect because the crowd is now nervous, like, oh wow, the property's underwater, you need new money to come in and shore up the balance sheet. So that's where the foreclosures are happening at this moment in the game, in multifamily in particular, is the syndicators who can't successfully recapitalize these losses that are resulting from their debt structure.
mm-hmm.
And then, the perfect storm would be if interest rates are still high and we get a bunch of job losses and the rents start to go down. Then multifamily will start to feel like the office market where the top line is going to go away too. And then those numbers look worse and worse and worse. And you could get a GFC type decline of 40% in valuations.
Gotcha. This makes sense. A couple quick questions before we move on from this. What in the world would possess someone to borrow with floating rate debt going back to 2020, 2021? Like, why was that like even an option? Like, with rates so low, why didn't everyone just term out their debt like most corporate borrowers did, like most sort of residential borrowers did in the mortgage market? Like, what kind of created this problem for some borrowers? And if you can estimate kind of what percent, I mean, I'm sure it's impossible to know, but like, what rough percentage do you think is out there that's floating rate versus fixed rate?
Yeah, it's hard to know the percentage, but I think that 3.6 trillion number that people have been talking about for the sort of regional bank exposure or the commercial bank exposure to real estate.
Mm-hmm.
I would imagine a big chunk of that, like over 50%, is floating rate.
Wow. Wow.
So that there is an actual problem with that stuff because the math that I just showed you makes the refinancing those properties difficult without coming with, you have to basically, to refinance them, you have to come up with a huge bunch of cash because they don't pencil anymore for the banks. But it's complacency ultimately, and then risk seeking. So the downside of taking these fixed rate debts instruments is that they have huge prepayment penalties on them.
Mm-hmm.
And so if you're in the game, and this is why this point I brought up earlier is important about the financialization of real estate. If you're in the game of buying, sell, and fixing and selling real estate instead of holding for cash flow, you're incentivized not to put the fixed rate debt on it because you don't want to have a huge prepayment penalty.
Gotcha. So
Yeah,
if you're chasing price appreciation, you want the floating rate loan
yeah,
because you
yeah.
want to get in and get out. Gotcha. So I can imagine certainly during, 2020, 2021, and maybe even early in 2022, when, asset markets are still quite buoyant, going back to this original chart, I'm guessing a lot of folks were like, let me floating rate this. I can sell it to the next buyer or sell it to private equity or sell it to whomever is going to buy it after me at a higher price. And obviously that expectation has been proven wrong.
That's right. Yep.
Cool. All right, keep moving here. What you got here in this chart here? Year-over-year investment
This,
volume by category.
yeah, this one we don't need to spend too much time on it. It's just an indication of sort of the same phenomenon we talked earlier, which is people are just not doing anything. This is
Yeah.
just there's a volume recession in transactions. It's huge,
So
right?
that's not. These are down 63% year over year, down 70%. Gotcha. Holy cow! You're talking about down 60 and 70.
Yeah,
This is absurd. I didn't realize it was this dry.
yeah. People they're not transacting and they're holding on. The ones who are holding on, they're holding on for dear life, or they have fixed rate debt and they're sitting pretty.
Gotcha.
Um, they just want to get through the storm. It's essentially there's this giant waiting game. Like there's all this dry powder out there. Investors know that if they can just weather this shock, this interest rate shock, if you will, there may be a sunnier period on the other side where they could sell, back at the 2022 values.
How does one weather an interest rate shock? Do they have to have interest rates go down, or do they have? I mean, obviously, interest rates could go down in the future, or cap rates could rise in the future. But it seems unlikely that both of those things are going to happen, or even one of those things is going to happen without actually having to go into a cycle, right? We need to see unemployment go higher. We need to see growth go materially lower to get interest rates materially lower, or we need to see employment and income accelerate materially for cap rates to go higher. So like to me, it's like it's almost like a catch-22, where no one is incentivized to do anything. But the longer everyone does nothing, the more likely it is that the bad thing happens. Am I
Yeah.
kind of reading too much into that?
No, I think that's right. Like we're in such a difficult moment to see through the clouds and see what's going to happen because what most real estate investors are complaining about is interest rates. But as you pointed out, to get lower interest rates, you're going to need to see probably damage to the economy, unless there's some kind of historical anomaly, where we get through it without we get a situation where inflation comes down enough to incentivize the Fed to reduce rates without having job losses. It doesn't seem like it's possible. But there's another scenario here related to what I spoke about earlier, which is this real estate is the biggest inflation expectation in the system, which is there's a scenario where those who can survive the rate shock by either bringing fresh equity into their transactions or maybe they were prudent and had already structured fixed rate debt, there's a possibility where where the market sees real estate inflation at a high enough clip to overwhelm the increase in borrowing costs. And so let's say you get a world where one of the scenarios you talk about sometimes where inflation is sticky.
Yeah.
Well, real estate could actually do okay even in that world if the underlying rent pressure, for example, in multifamily was higher than the inflation. Like let's say CPI is stuck at 5 and multifamily rents are moving at 10. Well, that's probably enough for the properties to increase in value, even in the face of these higher costs.
Gotcha. That makes a ton of sense. I mean, if we can, what's my secular inflation model here? So we do have a very strong conviction that inflation is going to be higher and stickier in this particular cycle. Colin, if you can throw our secular inflation model chart here on the board, where we show, so this model we built back at the beginning of last year as effectively trying to answer the question that I think a lot of central bankers went to Jackson Hole to try to answer this year, which is, have all the things that we've observed that have changed in the economy since the advent of COVID, have those things contributed to a higher trend rate of inflation? And the secondary question in terms of Jackson Hole was, do we need to do anything about that? The answer was no and no. We disagree with the no and no, and we ultimately think we're going to be proven right on this for a variety of reasons. But in terms of this model, what this model is suggesting is that based on these 20 features that we know to be correlated or co-integrated with the underlying trend in inflation, which itself was 1.6% in the previous decade. The change in these factors, the movement relative to their own baselines and their own trends, suggests that inflation core PCE is somewhere between 2.5 and 3.2%. So effectively, the underlying trend of the time series, like this flat line here, that kind of the core PCE is oscillating around, it's gone from 1.6% to 2.5 to 3.2%. Now, if that's the case, clearly, if you think about core PCE, core inflation in general, shelter is going to be a large component of that, somewhere between 35 and 40% for both of those indices where you look at PCE or inflation and inflation, CPI inflation. So this is, you're effectively saying if this model is right, you're going to have new buyers come in and say, well, we'll take it off your hands because this is a great investment going forward. Is that effectively what you're arguing?
Yeah, yeah, exactly. Like, as long as the fundamentals in that industry that we're talking about are strong. So like, let's assume that the world has inflation, but the job market's strong and multifamily rents are on the rise. If they're high enough, the new buyers will come in and say, okay, I'm good. I'll structure it. I'll pay a little bit more. You can still get decent loans, fixed rate loans in the fives or whatever. If you borrow in the fives and inflation in your underlying assets at 10, you're going to make money. You're going to financial engineer the same kind of return that you were trying to do in the pre-COVID era. It's just going to be at higher numbers, essentially. But you do need to, as an investor, you need to believe that the rents are going to go up more than the borrowing costs.
Gotcha. Yeah. So it's really about the change. It's not about the level of borrowing costs. If you can afford the borrowing costs, what you care about is the change in rents and the change in operating income on a go-forward basis.
That's
is that
right.
correct?
Yeah.
Gotcha.
That's right.
You said one thing before we move on that kind of caught my attention, and something I've heard when people discuss commercial real estate throughout the year, but I don't really understand it, which is borrowers may put in more equity. What does that mean in the context of kind of what we're discussing?
Yeah, like, I'll give you a couple different iterations of this. Like for us, for example, I mentioned we had a couple deals where we had floating rate debt on them. They were development deals. And what happens, we're just as underwater as anyone else on that chart. Yeah. But you can fix the balance sheet of a real estate deal by putting in new equity. So let's say you were at 70-30 and then this thing, the debt goes up and you're underwater. Well, you just pay down your loan.
Gotcha.
You put new equity in and you sort of restructure the balance sheet and say, okay, fine, I can't afford 70% leverage anymore, so I'm going to get down to 50. And then I feel better about it. And that works for the well-capitalized players. And where the problems are emerging right now are in assets that have no future hope. That's office. So even though many of the people who own offices are actually financially capable of putting in fresh equity, they're basically like in GFC mood, basically saying like, you know what, you take it. I'm done with this stuff.
We've seen a couple of those, huh?
Yeah.
Yeah. And what do the banks do? They don't want it, obviously.
Yeah, they don't want it either. Nobody wants it. Yeah. And then the multi-syndicators, they struggle because their equity is like a crowd-funded form of equity, and some of them have been successful at replacing or finding fresh equity, but that's a tough conversation, right? You go to a bunch of retail investors or even sophisticated investors, say, hey, I know I told you we needed $10 million for this deal, but we actually need 40. And can you please write your corresponding check? A lot of people say no.
No, I'm good. Here's another 40 thrown at the abyss because we have no idea how this is going to play out longer term.
That's right. Yeah.
Yeah. And speaking of how this plays out longer term, right? You put a chart in your slide deck about this office occupancy trend. Colin, if you let's back up on the screen, in terms of the U.S. lagging far behind Europe and Asia and these return to office rates. Like, can you walk us through what this looks like and kind of your own gut feeling about where this is headed longer term?
Yeah, I wanted to share this just to give people a sense of how bad it is out there. America is at 50% occupancy and trailing Europe and Asia by quite a bit. They're for whatever reason, culturally, they've been able to get people back into the offices at a faster clip. Mm-hmm. The U.S. looks like it's just not going to happen. Even though, from anecdotally talking to the CEOs I know around town, like everybody wants their people back in office, but the workers don't want to go. And so I think that what this chart is showing to me is that there is going to be, no matter what scenario like we get into, office is going to really struggle, and the owners of office are going to struggle.
Yeah.
Because I don't personally see this trend sort of reversing quick enough, or ever maybe, and it's a problem for that asset class.
Gotcha. And so give us some indications on like what the broader sense of this risk is, what the exposure is, like how big is office relative to broader commercial real estate? In your estimation, like what percentage of this is, interest only or sorry, not interest only, floating rate versus fixed rate? Like is this the boogeyman that everyone has been sort of conditioned to believe it is if you turn on financial podcasts or finance Twitter?
I think so. I don't have the numbers top of mind, but I do think it's, objectively speaking, a real problem. But I also think that it might not be as damaging to the broader economy as you would think based on sort of the Twitter chatter. And the reason I say that is that these trophy offices, or even non-trophy, just offices, they're essentially owned by pension funds.
Yeah.
And the pension funds, they don't like to take these losses, but they're actually sort of suited to take them, right? Because they have huge diverse portfolios. And so it's not the same market, right? There's very few individuals or very few institutions outside of a giant pension or something like that that has any exposure to office.
Mm.
So it's going to be damaging. It's going to cause problems for the cities because they depend upon property taxes, and there's all kinds of other things that may impact the economy. But the fact that people are going to lose money on these deals is not that consequential, probably.
Gotcha.
Yeah.
Gotcha. Yeah, and I tend to think of that as well. Like when you think about what happened in the GFC, these banks, so much of the asset side of their balance sheets were basically toxic assets, right? And so they had this, they were effectively insolvent, by and large because of the degradation that we saw in, mortgage-backed securities market. This is not the same problem, right? One, you don't have, or sort of the folks who own this stuff, generally speaking, aren't banks, or if they are banks, they have minimal exposure, de minimis exposure relative to the broader commercial banking system, right? We've seen that, was that presentation from the Fed a couple of quarters ago, maybe a quarter ago or so, where they basically said, hey, look, there's like $1 trillion of commercial real estate exposure, and it's primarily in these small to mid-sized regional banks. It's not the systemically important financial institutions. So if there is going to be a problem, you're effectively arguing, and I'm, tell me if I'm repeating this wrong. You're effectively arguing that it's going to be largely contained to the folks who issued the loans and or own the assets, and it's probably not going to have this broader spillover impact to the broader economy. Is that kind of a key takeaway there?
I think so, and with one caveat, I think the office ecosystem decline is going to be very problematic for large cities
Mm,
because of the way in which they sort of finance their local government budgets.
hmm
And so the big cities are in, there's some been reporting on this, which is pretty good. Like if you type in like property tax doom loop into Google, you'll find some good articles about this. Like it's a problem for New York, for San Francisco, for LA, that people aren't coming to the offices because the local economy, which relies on things like sales tax and property tax, is getting crushed by the lack of people around in these downtown business centers. And so that could manifest into some ugly dynamics in the cities, and cause, I don't know, I haven't done the math, but like I have to imagine that a 50% price decline in office is like an existential threat to the budget of a city like New York.
What were you saying? Because they are taxing these office properties, it's a meaningful chunk of their revenue, or you're
Yep.
saying just a general economic activity that it comes from people going downtown every day is a big chunk of the revenue, or both? It's probably both.
Both. It's both. Yeah. Like
Yeah.
depending on the state, like California's got a funky tax system because the taxes are like locked in place as a result of this Proposition 13 for a lot of different property types. But in many places, the taxes float with market value. And so market values are going to go down. So the property tax roll are going to go down. And so it's a problem for them because it's a huge component of them, and especially in these like super dense places.
Gotcha, gotcha. We're gonna I know I'm gonna be
Yeah.
respectful of your time. We're getting a couple questions here. Well,
Sure.
one's just a comment. We got a comment from our friend David M. He says, "I'm in this with you. Got a floating rate loan, 80% loan to value, trying to sell ASAP. Hashtag pain." So we feel your pain, David. This is and by the way, David, this is the pain that Jay Powell told you he was going to cause back in Jackson Hole last year, right? Like, if you want to see pain, like clearly the interest rate sensitive sectors of the economy are the ones that are going to feel the brunt of tightening through the policy rate, right? There's so many reasons why the economy itself, and this is what we've argued in our macro scouting reports for the past year, is that there are a lot of reasons structurally and cyclically why the economy is less sensitive to interest rates broadly. But the segments that are interest rate sensitive are going to have big problems when you go from 25 basis points in the Fed funds rate to 550 as we are currently. Second question from our friend Michael. How you doing, Michael? It says, I do have a question. So will this extend and pretend eventually lead to the banks to allowing the banks to capitalize missed interest payments, or will the Fed require equity holders to pay back interest and pay down debt?
It's a great question. I don't know is the answer. I think that the Fed also learned a lesson from the GFC. And what we've seen with banking crises, that sort of mini regional banking crisis we had so far, is that the Fed and the FDIC and all the powers that be are willing to be active or be aggressive in the way in which they try to resolve these issues. And so I suspect that we'll see the same bias towards not punishing the banks, not making them, do from a regulatory perspective, not making them take these losses, and figuring out some way. Like, I don't know all the banking stuff. We might probably better get a banking expert on to discuss like how they would go about not messing up their capital ratios and stuff. But that's what I think they're going to do if I had to guess.
Well, they're good. I mean, they could change it, right? The capital ratio comes from a place, and it's called the regulator. So the regulator could, in fact, change it. And I'm not really big on most hardworking small business owners like myself and yours, or you're not small anymore, but we're not big on getting bailed out by the government, right? Like, generally speaking. Yeah. But I can see a very credible case to be made, which is COVID is like a random thing. Like, it's not like banks were going nuts in terms of lending. If anything, they reduced their exposure to this asset class in terms of loan to value ratios and things of that nature, and all these covenants that we have now that we probably didn't have prior to the GFC. So banks could come hat in hand saying, look, man, we did all the right things, all the right stuff that you told us to do, and now we still have this big random problem. Don't allow a pandemic to basically put us out of business. And so I have a sense that's probably, generally speaking, politicians go in that direction, and we're obviously in a fourth turning. So things like populism, bailouts, socialism, all those things are going to continue to rise. Fascism will be the final phase of that fourth turning crisis that we're in. So I do believe this is something that could keep the game going for longer, right? Like, one thing I'm kind of hearing from this discussion, which is, and again, please correct me if I'm wrong, this is my interpretation of the discussion. There is a big problem out there. It's going to take longer to play out. It's probably going to be more concentrated than the average investor thinks. And there are actually outs from a regulatory standpoint to actually deal with this and either make it go. Now, that's not going to go away because people don't return to office, but you can make the pain, kind of spread the pain out across many years and eventually broader business cycles. So is that a good summation of what we're discussing?
Yes, it is. I think so. I think there's still this hope out there from the politicians in the big cities and the office owners that maybe that chart that we just looked at, like maybe it reverses, right? Like, maybe occupancy gets back to some kind of closer to normal level, and then only like the crappy office buildings will be foreclosed on instead of everyone.
Gotcha.
Yeah. And that's possible. Look, the CEOs, like, if you kind of sentiment chatter, like the CEOs around the country, they want people back in the office. So it's very possible that trend could reverse and start to look more like Europe and Asia.
Well, think about this, right? Like, right now we have a very historically tight labor market. It was tighter, 2 quarters ago, but it's still historically tight. If you look at measures like total unemployed, we still got 2.5 million in excess labor demand relative to labor supply. So until that number gets back into better balance, workers have the upper hand. This is why UAW is striking. This is why the Screenwriters Guild is striking. This is why someone else is going to strike after UAW strikes, right? Like, the workers have the upper hand in this particular business cycle. But if they start getting fired in mass and the unemployment rate goes from where is it now, 3.7% to 4.7 or 5.7%, I think a lot of butts will be back in those offices really quickly, right? And so there is that hope out there that this cycle which is, we see all the risk factors on the table now, but those risk factors could evolve in a way that actually is positive and not necessarily get incrementally negative, depending on what happens with the labor market. So, and ironically, like a bad jobs market for one cycle, for a multi-month or multi-quarter period of time might actually be the solution we need longer term from the perspective of the commercial real estate office segment. So that's interesting. Dynamic.
Yeah, that's a really interesting point. Yeah, it's like if this labor hoarding phenomenon goes away, it's probably way easier to get people back in the office. I think that's right.
100%, man. All right, you've been more than generous of your time. I did want to hit you on this one final chart because this is, to me, it's very interesting. I like cross-sectional analysis for as an economics geek. So talk about what this is showing.
Yeah, actually, if you don't mind, let's go through the last couple ones really fast because I think they're fun. They're fun too. But let's start with this one.
Yep.
So one of your themes on the list of 10 or 11 is this perfect storm for home building, and I firmly believe that. Like I went on a Real Vision podcast like in June of 2022, and my case was why people should be bullish on housing, and this is like right before the Fed is about to jack rates by who knows how much, right? It turns out that I was like really right, and early I beat Buffett by like a year. He just put 800 million into the home builders, but it's a function of like the market is so messed up. You have this like perfect storm of demand. COVID unleashed a new demand into the world about people wanting a secure place to live, which in this country is a single family house is sort of the manifestation of that. And millennial generation starting to have kids, so they want houses. And then the political sort of backdrop for development is a disaster. Like the housing market is one of the most egregious examples of market failure in the entire system. And it's not just a US problem. That's why I wanted to show this chart. The politics of like NIMBYism and all this crap that causes development in this country to be a problem is a big problem everywhere. Gotcha. And this financialization of housing has caused housing to go in the wrong direction in terms of affordability all around the world. And that's why if you go to the next chart, like that's why you see, this is from June when I went on the show, like, man, the home builders are up 36%. And like the volumes of transactions is similar to the commercial real estate, right? Like people aren't really buying homes, but what's happening is the home builders are capturing ever greater market share. So I forget the exact numbers, but I think in a normal healthy market, the home builders were something like 15% of all home sales, and now they're like 30. So in 1 year, they doubled because all these people are stuck in their mortgages. They're not going to sell their house and go get a 7% loan. So the home builders are sitting pretty, and unless interest rates go back down, they've got a multi-year opportunity to capture market share in the housing market. And that's why you're seeing these moves and you're seeing guys like Buffett get into it.
Yeah, no, that one phenomenal call, Nick, and just want to congratulate you on having the foresight to basically stand against the macro dooms consensus, last summer alongside me, which is this economy is going to do just fine, and obviously that was one of those reasons. We kind of, I think, want to say in October of last year, we came out with the view that hey, this was a perfect storm for home building, and it's all for all the reasons you just indicated, which is primarily that record spread between the marginal mortgage rate and the effective mortgage rate, right here, these two lines here is creating a perfect storm for development. And the blue line in this panel here shows a U.S. housing starts to existing home sales ratio. And so effectively, how many starts are we creating relative to how many existing home sales are? Now starts are going up and home sales are going down. So obviously the ratio is rising, and we hit a new all-time high in this ratio in the most recent month of data. So very much on there. I've been on board with that with you on this theme since going back to last fall. And I just want to say again, congrats again for having the foresight to see this stuff in real time.
Thanks, man. Likewise.
Of course, man. Absolutely. And then what was this final chart here?
Okay, a fun chart. So I was thinking about I don't really trade stocks or whatnot, but this is a potentially a fun pair trade, because another thing that's happening out there in the world is that the cities are demonstrating from a political standpoint that they are determined essentially to regulate short-term rentals out of existence. And so you're seeing stuff like in New York, just recently, they passed another more restrictive component of it. And even the places where it was booming, like in the Southwest, the political winds are going in the wrong direction. And so that there, in my view, there's sort of an interesting pair trade where, depending on your view on the economy, you get long the hospitality industry and short the short-term rental industry. And
Gotcha.
it probably does okay because they are coming for the short-term rentals. Like the leading indicator is New York City and Los Angeles, and I feel like the whole country is going to look like that before too long because of the powers, the local political powers.
That's so interesting. Why are they coming for short-term rentals? I mean, it's clearly an awesome thing if you're a consumer. Like, what's the downside for this? I guess I'm a little naive.
Yeah, it goes back to that chart with the shows like the price to rent for housing.
Yeah, right here. Colin, you
So
put it up.
yeah, what's happening at the local political level across the world is that the constituents are complaining about the housing affordability problems in their local neighborhoods. And Airbnb and VRBO are easy scapegoats, right? If you think about it, if you're a local politician and you're like, well, in my subdivision, there's 40 houses that are up for Airbnb. That's 40 houses that are not being entered into the market for sale for people who want to live in this neighborhood. So whether or not Airbnb is to blame for the housing affordability crisis, it's not, by the way.
Yeah.
That's what it's the lowest hanging fruit for the politicians. It's like, oh yeah, let's just ban short-term rentals. Like that's what they want to do. So I feel like that's probably going to just keep happening.
Absolutely. It's like when was it London or some major city tried to ban Uber, and it's like this is the dumbest thing ever. They're gonna renege on
Yeah.
this in another couple of years, and I think they did.
Yeah.
Nick, man, this was a whirlwind. You've been super generous with your time. I just want to say thank you for all these insights. You're a great dude, do a lot of great work in the community as well. So appreciate and kudos to you for that. I ask every guest that we have on this program one final question before we let them go, which is my favorite question generally, which is what's one piece of risk management advice that you know today and it's near and dear to your investing strategy that, and it could be in real estate as well, that you wish you knew at the beginning of your career?
Okay, let me think about that. I feel like real estate, I'll do real estate just because that's where I have the most experience.
Yep.
In the stock market, right? One of the risk management ideas, that people talk about a lot is like, oh, you can if a trade goes against you, just sell it. Don't double down, don't hold it. If your thesis is wrong, let the market sort of tell you.
Mm-hmm.
Well, the problem in real estate is that you can't really always do that because it's even in the most liquid markets like single family houses in Los Angeles, it's still kind of hard to sell. You got big transaction costs, you got to pay a broker. You
Yep.
can't really just do that. And so one of the things that's been sort of like beaten into my brain is that you really have to understand a real estate deal before you buy it.
Mm-hmm.
You have to be prepared to own it for much longer, and you have to structure the capital structure accordingly. And that's where the most of the mistakes I've made is in entering a real estate transaction with a business plan that was valid, but with a capital structure that only works for one scenario. Like if you hit your business plan, then everyone makes money. But you really need to think, you need to take a step back and say, okay, what are the other things that could happen? And if that happens, how would I want my capital structure to look? Maybe I do want the fixed rate debt, or maybe I do want the leverage ratio to be much lower. So it's like really challenging yourself to think through the scenarios with the understanding that you might be stuck in this thing, right? Anything could happen. We know that you could get COVID, you could get a 500% increase in interest rates. And so you have to be prepared in real estate to hold it and to structure your deals accordingly.
That is phenomenal advice, man, and I love that it was specific to your asset class, man. So, when we launch Darius Dale, a family office, and we're doing some real estate deals, hopefully with you in the future, I'll
Let's do
definitely
it.
keep that in
Yeah.
mind. Absolutely, my friend. Well,
Yeah.
Nick, this is fantastic, man. We'll definitely have you back on the program. As I mentioned, everyone, where can folks come to find you on social media and maybe check out your blog and your podcast?
Yeah. So best place to find me is just my name, nichalaris.com. You can sign up for my newsletter, which is sort of a weekly newsletter about a lot of different things about finance, but also about life and how to think about success differently. And then my podcast is the Nick Halaris podcast, which you can find on any of the sites. Just type my name in again, and would love to have your support. So thanks.
Of course, man. Absolutely. So everyone, give Nick a follow, give him a like. Like I said, he does great work. and we'll definitely be having him back on the program. So next month, we'll catch everyone back here with Bob Elliott of Unlimited Funds. Go back to last January, rewind the tapes. Bob and I co-authored the transitory Goldilocks theme back in mid-January on this very program. So I'm excited to kind of get his update on that next month. So we'll catch you back here then. Everyone, cheers. Have a great day and enjoy the rest of your weeks.